Welcome to TalkTickers. We're diving into the latest from Noodles and Company today.
Yeah, their first quarter 2025 earnings call just dropped, and there's quite a bit to unpack.
Absolutely. So our mission, as always, is to cut through the noise and give you the essential insights. Let's get straight into the numbers.
Okay, so headline news. Positive momentum on sales. Same-store sales, they saw a pretty decent bump.
How decent?
4.7% for company-owned spots and 4.4% across the whole system.
Okay, that's not bad at all.
And it looks like that trend kept going into April. They mention preliminary numbers showing roughly a 5% increase since they rolled out that new menu mid-March.
Good sign. What about total revenue?
That came in at $123.8 million. It's up, but only about 2% compared to last year.
Okay. So comps are strong, but overall revenue growth is a bit softer. Interesting. But I also saw something about a loss.
Yeah, that's the other side of the coin. Despite the sales growth, they reported a net loss of $9.1 million for the quarter.
Oof. How does that compare?
It's bigger than last year's loss, which was $6.1 million.
Right.
And adjusted EBITDA was also down $2.4 million compared to $5.5 million last year.
Right. So selling more noodles, but profitability took a hit. Why the gap? What's driving those costs up?
Well, it seems to be mostly tied to their big strategic push, particularly the menu revamp.
Okay.
They specifically called out higher cost of goods sold, basically. The food costs more, partly because of the new ingredients.
Makes sense. What else?
Labor costs were also up. You've got general wage inflation, plus, importantly, one-time costs for training everyone on this massive new menu.
Right. That training piece can be significant.
Definitely. And then there were other operating costs, think third-party delivery fees, which are always a factor, and increased marketing spend. They're pushing this new menu hard.
So it sounds like a major investment phase. Let's dig into what's actually pulling people in. You mentioned the menu rollout.
Yeah, that seems to be the main catalyst. So they actually did a smaller launch back in October 2024, which gave them a bit of a boost.
Right.
But the really big overhaul was March 12th. That's when things really seemed to accelerate. Oh, and Easter timing helped a bit too, maybe 0.5% on the comps for Q1.
But the menu is the star here.
Yeah.
How big of a change are we talking?
It's huge. They said nearly 2/3 of the menu is now either brand new or significantly improved, like the biggest transformation in their history.
Wow. 2/3. So what's new? What kind of stuff?
They leaned into comfort, especially mac and cheese. Think pulled pork barbecue mac, garlic bacon crunch mac, buffalo chicken ranch mac, lots of mac.
Sounds decadent. What else?
There's a Cajun shrimp fettuccine, a green goddess chicken salad for something lighter. And they also spruced up some old favorites like their pesto cavatappi, rigatoni rosa, the classic cheddar mac, even the chicken Caesar.
Okay, so a real mix. And it wasn't just the food itself.
No, they also upgraded their presentation, better takeout packaging, actual ceramic plates for dining in, which is nice, and updated digital menu boards. Kind of refreshing the whole experience.
And are people buying it? Literally.
Apparently, yes. The company sounded really positive about the early feedback. They said guest response, particularly for those new mac and cheese dishes, has, quote, significantly exceeded expectations.
That's a strong signal. People love their mac and cheese.
It seems so. And they're making sure people know about it with a new brand campaign, too.
Right, the We Know Noodles campaign. What's the angle there?
It's about positioning themselves as, the only national chain that's all about noodles, really owning that niche.
Makes sense.
They've got new commercials focusing on the love for noodles and showing off those new mac dishes. Apparently those tested really well.
And they're spending more to get eyeballs on it.
Yeah, increased investment in paid media, digital out-of-home, digital audio, social stuff like Pinterest, plus PR and influencer campaigns to generate buzz.
Sounds comprehensive. Any sign it's translating to loyalty.
Seems like it. Their loyalty program saw double-digit growth in transactions and signups. They mentioned a recent taste tour promotion that apparently did really well too, so engagement seems to be up.
Okay, so lots of activity, lots of investment driving those sales up. But let's circle back to the costs because that's where the pressure is. Can you break down those numbers a bit more?
Sure. So COGS, the cost of ingredients, hit 26.6% of sales. Mainly the new menu items may be a bit pricier. They did note food inflation itself was only around 2%.
Okay, 26.6%.
And labor.
Labor jumped to 32.5% of sales.
Right.
That reflects wage inflation, which they pegged at 2.7% hourly, plus those one-time training costs we talked about.
Got it. And the other costs.
Other restaurant operating costs rose to 21.1%. That bucket includes things like the third-party delivery fees and that increased marketing spend.
So all those add up and squeeze the margins.
Exactly. Restaurant-level contribution margin came down to 10.3% for the quarter. Q1 is usually seasonally lower anyway, but those costs definitely weighed on it.
But they expect some relief.
They do anticipate COGS will probably normalize a bit, maybe closer to 26% for the rest of the year, so some improvement expected there.
What about overhead, like G&A? Actually, G&A expenses decreased, came in at $12.8 million, mostly due to lower salary and incentive compensation.
Oh, interesting.
Although that saving was partially offset by some costs related to the menu rollout, about $500,000 year over year hit G&A, and maybe another $1 million in one-time costs spread elsewhere in the P&L.
Okay, and they're spending less on building stuff too.
Yeah.
CapEx?
Yeah, significantly less. Capital expenditures were only $2.9 million, way down from $8.6 million last year. They're being more cautious with spending there.
Any changes to the store count?
They opened 1 new company restaurant but closed 3 during the quarter, so a slight net reduction there.
Okay, so pulling back on CapEx, trimming a few stores, managing G&A down, but investing heavily in the menu and marketing, which is boosting sales but hitting near-term margins. That seems to be the picture.
That sums it up pretty well, and their debt situation looks manageable. About $12.7 million in debt, with over $19 million still available on their credit line.
So looking forward, what's management's tone? Are they feeling good about this strategy?
They sound pretty confident, actually. They believe these changes are really strengthening the business foundation and gaining traction.
What's the focus now?
Operational excellence, basically, making sure the restaurants run smoothly with the new menu and sustaining that sales growth. If they can keep the top line moving, maybe, just maybe, new unit growth could be back on the table down the road.
But not immediately.
No, seems like the focus is stabilizing and improving the current base first. And they also mentioned continuing to look for cost savings to help the balance sheet, especially in the back half of the year.
Did they give specific guidance for the full year 2025?
They did. They reiterated their revenue guidance, $503 to $512 million, and they expect mid-single-digit comp growth for the year.
And margins?
Restaurant contribution margin projected between 12% and 14%. They did slightly widen the lower end of that range, though, citing potential impacts from tariffs. So a little note of caution there.
Okay. And store plans for the rest of the year?
Plan is to open 1 more company-owned spot, but close quite a few more, 13 to 17 company-owned and 4 franchise locations. So a net reduction overall for the year.
Consolidating the footprint. What about total spending?
Total CapEx for 2025 is estimated at $11 to $13 million, and they're projecting they'll be free cash flow positive in Q3 and Q4.
Right. So getting back to positive cash flow later this year is a key target.
Definitely seems to be a priority.
Okay, so if you're listening and trying to size up Noodles and Company, what are the main things to chew on?
Well, the strong comp sales and positive traffic are definitely the green shoots here. It really suggests this massive menu overhaul, and the marketing push are actually working, resonating with customers. Could be a real turnaround story brewing. But the costs associated with that launch are hitting profits right now. The bet is that margins will improve as sales keep growing and those one-time launch costs fade away. And you see that discipline in cutting CapEx and managing debt, which signals they're serious about shoring up the finances. That tariff mention, though, adds a little wrinkle of risk to watch.
Definitely something to keep an eye on. Okay, let's shift gears slightly. Time for our This Is Not Financial Advice segment. What wild, maybe plausible trade idea does this earnings call spark?
All right, here's a thought experiment for you. Purely hypothetical, of course. How about this? Go long Noodles and Company stock. Ticker NDLS.
Okay, betting on the turnaround.
Exactly. But you hedge it. Simultaneously, take a short position in a broad restaurant ETF, like, say, EATZ, or maybe something focused more on quick service restaurants.
Long Noodles, short the sector. What's the thinking?
The thesis is that Noodles' success, if it continues, is very specific to their strategy, the unique noodle focus, that massive menu change. You're betting that we know Noodles isn't just a tagline, but a differentiator that allows them to outperform the general restaurant industry.
So you're isolating the Noodles-specific story.
Precisely. If the whole sector faces headwinds, like maybe consumer spending slows down, the short ETF position could cushion the blow. But if Noodles' specific strategy really clicks and they start grabbing share because they're different, the long NDLS position should, theoretically, outperform the short ETF hedge.
You're betting on their unique identity winning out relative to the competition.
Yeah, it's a relative value play, betting on the effectiveness of their specific turnaround plan against the broader backdrop. A pure play on whether their noodle-centric strategy is the secret sauce.
That's certainly a creative way to think about it. Definitely food for thought.
Just a thought experiment.
Absolutely. And on that note, that brings us to the end of our deep dive on the Noodles and Company earnings call. We've hit the key results, the strategies in play, and hopefully given you some context.
Yeah, hopefully that helps you understand where they are and where they might be headed.
Remember, this is our take. Always do your own homework. We're curious, though. What do you think? Is Noodles on the right path with this big menu shift? Let us know.